Okay, let's look at question 3. The following two situations are independent, so that means A and B are different. Alright. No more hanging on, Al. That's it. We're going without you. Alright, Yellow and Black Proprietary Limited had the following equity accounts as the 30th of June 2018. During the year ended 30th of June 2019, the following occurred in listed order. Now remember that says listed order. We got a profit of 40,000 was generated, 8,000 was transferred to general reserves, an interim dividend of 4 cents was declared and paid, a final dividend of 6 cents was declared, and the company issued a further 50,000 shares at $2 each. Prepare the equity section of Yellow and Black Proprietary Limited accounts for the period ended 30th of June 2019. So it's the equity section, and the best thing about it is, there it is there. So you know the accounts that you have to pick out. This is not too hard. Should be just easy peasy lemon squeezy. So A. Alright, the first thing I need to do is share capital. And my share capital is 400,000, but we got information down here that says we issued 50,000 shares at $2 each, so that makes 100,000. So I'm going to add in there 100,000. So my share capital should be 500,000. Share capital is taken care of. General reserves is next. And we've got 30,000 in there, but we transferred 8,000 to our general reserve. So I'm going to put a plus 8,000 in there because that's going to increase my general reserves. That gives me 38,000.
You're obviously not looking for entries, you're not looking for private entries.
Private entries? What do you mean by a private entry?
So 8,000 was transferred in general reserve, we don't have to write that as an entry.
No, I'm just asking you to give me the new balances from here to whatever it is at the 30th of June 2019. Okay. So we've transferred in 8,000 in general reserve, retained earnings. Alright, so a profit of $40,000 was generated. Profits go into retained earnings. So I can tick that one off. 8,000 was transferred into general reserve. So there's only one place it can be really transferred in from, and that's retained earnings. So minus 8,000 out of my retained earnings. An interim dividend of 4 cents was declared and paid. Now this 4 cents is on 200,000 shares, so that makes $8,000. Tick that one off. How to 4 cents by 200,000 shares. Okay, and then my final dividend was 6 cents, was declared. Well, even though it hasn't been paid, it still comes out of my retained earnings, so that's a minus 12,000 there. Because that's on 6 cents was declared on my 200,000 shares. And we've already taken care of number 5.
Sorry, as you final dividend again?
Well, it's 6 cents per share at 200,000 shares. So 0.06 times 200,000 gives me 12,000. And in the first case, 4 cents per share by 200,000 shares gives me 8,000. So what do we got? We've got 20,000 plus 40,000 minus 8,000 and 8,000 again minus 12,000. That gives me $32,000. So that makes 570 as my equity. Now, nice easy 8 marks there. And it's pretty simple. It comes as 1, 2, 3, 4, 5, 6, 7, all of those, and 8. Alright, explain the difference between provisions and contingents and other types of liabilities and indicate how you would report a contingent liability. Well, let's start with provisions first. So this is B.
Unsure of time and amount. Is that right?
Yep. Provision is a liability. And as Sam just said, it's unsure of time and amount, but I'll put it as an obligation that's not fully known. It is recorded in the current liability section. Of the balance sheet. That's a provision.
Was that like when we were talking about the people who had, if there was like a lawsuit against them?
No, that's not that. That's a contingent one. So the lawsuit one will be a contingent liability. So the first one I've explained is a provision. So provision for warranties. So we know for something like that, a provision for a doubtful debt. So customers that don't pay, or where we have to give customers something else. Is a type of provision, and the other type is a contingent. And as you said, it's like so a contingent liability. It does not fit the definition of a liability. Doesn't fit the definition of liability, usually because it's a doubtful nature, but it's not probable. Not probable, or well, it can't be a present obligation, or usually what it is measured reliably. Yeah, you could say if it's not a current obligation, then it doesn't fit the definition. And this is normally recorded. Yeah. Recorded in the notes to the accounts. So the notes to the accounts is where we usually get that one.